VCCircle Classroom. I'm Radhika Bhatt and I'm a partner at Wadia Ghandy and Company. I'm here today to talk to you about funds. I'm going to describe what a fund is, the purpose for investing in a fund, or rather what the advantages of investing via a fund structure are, the process of forming a fund, registration requirements, etc., and a brief description of the life of a fund. A fund is essentially a pooled investment vehicle and can be formed as a company, a trust, a limited liability partnership, or a body corporate, pursuant to the AIF regulations, i.e. the Alternative Investment Fund Regulation promulgated by SEBI, the Securities Exchange Board of India. The fund is regulated by these regulations, and the fund must comply at all times with these regulations. The fund can be open-ended or closed-ended if it is a Category 3 fund, or a fund that essentially is a hedge fund or a hedge fund type fund. If it is a Category 1 or a Category 2 fund, the fund must be closed-ended. A Category 1 fund is a venture capital fund investing in unlisted private companies which are small or medium-sized, and a Category 2 fund is essentially your private equity fund. An open-ended fund is a fund that allows its investors regular redemption rights. A closed-ended fund is a fund where the investor is required to commit to keeping his or her money in the fund for a predetermined period of time that is agreed beforehand. Under the AIF regulations, a Category 1 and a Category 2 fund must have a minimum term of 3 years. That means the investor's capital is locked in the fund for at least 3 years. The persons who form a fund, or the cast of characters in a fund, is a sponsor who sets up the alternative investment fund, the manager, who is a professional entity that runs and manages the fund, selects the investments, makes the investment and divestment decisions for the fund, and during the life of the investments, oversees the investments for the benefit of the investors in the fund. There is a unit holder, or the investor of the fund, who holds the units of the fund and is beneficially interested in the economics of the fund via his investment in the fund. If the fund is a Category 3 fund, i.e. a hedge fund type fund, or has a corpus of more than 500 crores, the fund must also have a custodian. So this is a cast of characters and the basic structure of a fund. We will now go on to speak about the purpose of the fund. We're now going to talk about the purpose of the fund, or what are the advantages of investing via a fund structure rather than any other structure or directly. One of the main advantages really is the benefit of expert management advice. The idea is that you commit to putting your money into a fund because the fund is being managed by somebody who is full-time dedicated to investing that money in the best possible manner to bring the biggest amounts of profit to yourself. And the benefit of that expertise allows the fund to make profits, hopefully, and for the investor to gain from the expertise of the fund manager. The other advantage, obviously, is size. When the money of a lot of investors is pooled together, they have economies of scale. They can make bigger investments, they can make investments that they ordinarily would not have been able to make. And that leads into the third point, which is access. Retail investors do not usually have access to the wide amounts of data and time and unlisted securities that an expert would not ordinarily have access to. And investing via a fund will give an investor who does not ordinarily have access to these types of investments, access to those investments. The fallout also is to get diversification. So depending on the type of fund, the fund would diversify its investments by investing in various types of assets, into various sectors, into various geographies, all the time obviously tied in and tied together by the expertise of the fund manager. We're now going to talk about the procedures for forming a fund. The fund must be registered with SEBI under the AIF regulations. In order to be registered with SEBI, the fund must submit an application, and the SEBI will consider a number of eligibility criteria before deciding whether or not to grant registration to the applicant. The criteria are that the fund must submit, along with its application, its constitutional document. This constitutional document will be a trust deed if the fund proposes to form itself as a trust, or the articles if it is going to be a company, etc. This constitutional document must specifically allow the entity, the fund, to conduct business as an alternative investment fund and specify the category in which it proposes to conduct its business. So category 1, category 2, or category 3. It must also specifically prohibit the fund from making a public offer of its units, because an AIF, an alternative investment fund, must always be a privately placed vehicle. The manager must be somebody who is considered fit and proper by SEBI, and this is something it decides at its own discretion. So you must set out the experience that the manager has in managing funds, which must be a minimum of 5 years. The manager and sponsor's infrastructure and manpower are also of interest to SEBI, and this must also be set out in the application form. The applicant must declare what are the objectives of the fund, the targeted investors, the proposed corpus, the investment style, as well as the strategy of the fund and the proposed tenure of the fund. And the applicant must also declare whether an application has been made in the past which SEBI has rejected. Once SEBI considers all of these criteria, which are set out in the application form, SEBI will decide whether or not to grant the applicant a registration. The most important thing you must remember is that SEBI requires a fee to be paid. The fee must be paid at the time of application for the application to be considered by SEBI, and this is Rs 1 lakh. And if SEBI decides to grant the applicant registration, there's a registration fee on top of that 1 lakh of Rs 5 lakhs. I'm now going to briefly cover the life of a fund. Once SEBI gives you registration, or once the fund is registered, then the manager tries to raise funds for the fund, so i.e. seek investors. There are a few things you must remember over here. Each investor must commit a minimum of 1 crore rupees to the fund. This is a requirement of the AIF regulation. The minimum corpus of the fund must be 20. The other requirement is that a maximum number of investors can be 1,000 and no more. The sponsor or the manager of the fund must make a commitment of the lower of 2.5% of the corpus of the fund, or 5 crore rupees, for a category 1 or a category 2 fund, or of 5% of the fund corpus and 10 crores, the lower of 5% of the fund corpus of 10 crore if it is a category 3 fund. There is no exception to this, and a manager or sponsor must be cognizant of the fact that this investment will be required from the manager to the fund. Once the fund has raised its corpus and has got its contributors, the fund will then make investments on the advice of the manager. The manager will select the investments, the manager will look after the investments during the time the fund holds the investment, and the manager will make the divestment decisions. Once the fund has divested of some or all of the investments, the benefits or the profits, hopefully, of those investments will be shared between the manager and the beneficiaries or the investors. The manager usually gets a management fee on an annual basis for managing the fund, and also gets a share in the profits that the fund makes, which is known as carried interest or carry. This share is calculated as a percentage of the profits that the investors make over and above a certain hurdle rate, i.e. once the investors hit a certain hurdle, after that the manager becomes eligible to share in all the profits that the fund has made. Usually there is a 20-80 split, which means 20% of the fund's profits are given to the manager and 80% to the investors of the fund, provided that the investors have made a minimum profit of whatever the pre-agreed amount is, usually between 12 and 14%. And an AIF is wound up in accordance with its constitutional document or its structure. So a trust is wound up in accordance with its constitutional document. If the AIF is formed as a company, it is wound up in accordance with the Companies Act, so on and so forth. So hopefully what will happen is that a fund is raised, the fund is invested, the investment profits are distributed between the manager and the investors in the fund, and the fund is terminated at the end of its tenure. I hope I've been able to give you a brief insight into fund formation. This is Radhika Bhatt from Wadia Ghandy signing out. Happy investing.